Actually, at 71 years of age doesn't matter very much to me because silver bull markets are so profound that you can be a year early or 2 years early. And the amount of money that you make if you experience a silver bull market is so astonishing that the fact that you were a year or 2 years early doesn't matter. People say to me, Rick, how will I know that I'm in a silver bull market? And I ask them to look at charts of prior silver bull markets.
Okay.
You don't need to look for subtle symbols.
Like hockey stick.
Seminole bull market, the 1970s, the stuff went from $1.50 to $50. So
That's right.
let's get that one out of the way. Let's go to one in the early 1990s that people don't remember at all, 1990 to 1996. The stuff went, if my memory serves me correctly, from $4 to $25, a five-fold move in the silver price.
Okay.
That's for a bull market that people don't remember.
Yeah.
In the 2000 market, if I recall, silver had settled back down into middle single digits. I forget what the number was. Let's call it 5 just for fun. It's probably 10, I don't know. But it went from there to 50. I think your last question is fairly easy to explain. Until about, 16 weeks ago, as measured by outflows and inflows from the ETFs, the retail buyer wasn't in the gold market. It was the foreign central banks that drove the price up. Mm-hmm. And central banks don't buy gold shares, they buy gold. Mm-hmm. So the fact that an asset class went up, but a related asset class didn't go up is explained away by the fact that the buyers that drove the one asset class up, physical gold, don't buy gold shares. I think, by the way, that the gold market has particular legs because I still don't see aggressive retail physical buying, either through the physical ETFs like GLD or products like the Perth Mint or the Sprott Physical Gold Trust. And I'm hearing from the dealers that although physical demand is strong, it isn't overwhelming, which is to say that the gold price itself, the bullion price, is still mostly the province of central banks. I continue to believe that the momentum that we've seen in the gold price, as well as concern about the ongoing purchasing power of people's savings in fiat currencies like the US dollar, means that we will get an overlay of retail buying. When we get an overlay of retail buying, I would suggest that it's going to come up on top of the foundation of central bank buying, which is a different way of saying perhaps, I'm not saying for certain, but perhaps in American parlance, you ain't seen nothing yet, because I'm not seeing broad spread public participation in the gold market, physical gold market. One thing that's changed in this country, and I think it's interesting, is that the nation's third largest retailer, Costco, has begun to sell retail gold. And they literally can't keep it in stock. Their response, I guess, to a different audience than the traditional gold buyer, has been very dramatic. Dramatic enough that they're going to start selling platinum or palladium products as bullion in Costco too. In that one example, we've begun to see retail participation. But when I look for retail participation in the ETFs, or I look for retail participation in the Sprott Physical Trust, where I have data, what I'm seeing is a gold bull market that still is being led by central banks, not by living, breathing people. My viewpoint, the anti-gold, is the US 10-year Treasury.
Okay.
I realize that's a very American-centric point of view, but the US Treasury has for years been the benchmark savings instrument in the world. It's the interest rate that other yield products, foreign and domestic, are priced against. So let's talk about gold against its primary competitor, the US 10-year Treasury. Mm-hmm. The US 10-year Treasury at present pays about 4% interest, in a currency that I would argue is losing its purchasing power at about 7.5%, that the US dollar is losing its purchasing power at 2.6% a year. But the CPI doesn't include a few things that most people spend money on. As an example, the CPI doesn't include tax. Now, Carrie, I wouldn't complain quite so much about the index if I didn't have to pay the tax. But the truth is I do. And I think that when Americans, at least, look at the CPI and they look at the suggestion that that number is increasing at 2.6% compounded, and then they look at the price of gasoline over 4 years, or the price of food over 4 years, or the price of health insurance over 4 years, or the price of mortgage interest rates, or the price of rent, this 2.6% escalator is stupid. It's absolutely silly. So let's go back to the US 10-year. They pay you 4% in a currency where your purchasing power is declining by 7.5%, which means that the US 10-year Treasury costs you 3.5% of your purchasing power every year for 10 years. If you give your money to the US government, they will give you back 60% of your original purchasing power over 10 years. That's what gold's competing with. Now, that's a hell of a deal.
In recent conversations, Rick Rule explained the unusual dynamics in the gold market right now, underscoring a critical trend. Although gold has been rising in value, This momentum hasn't been mirrored in gold stocks or ETFs, like the physical gold ETF, GLD, or other prominent products. Why? The answer is relatively simple yet profound. Central banks are driving this current gold bull market, not retail investors. Central banks buy physical gold, not gold-related stocks or ETFs. Rule emphasizes that while many investors typically see a rise in gold stocks alongside a rise in gold, this unique bull market is an exception, largely due to the purchasing habits of central banks. Rule's insights suggest that we're just witnessing the beginning of this bull market's potential. He explains that retail investors still aren't heavily involved in buying physical gold, nor are they flocking to ETFs like the Sprott Physical Gold Trust or the Perth Mint products in massive numbers. Instead, central banks have been leading the charge, buying up large quantities of gold as a strategic move to protect their reserves from the ongoing devaluation of fiat currencies, particularly the US dollar. The purchasing power of traditional currencies is under severe pressure, with fiat currencies like the US dollar losing value each year. For context, the US dollar's purchasing power decline is officially measured at around 2.6% annually by CPI, but Rule argues that this is a gross understatement. Key expenses such as taxes, gasoline, healthcare, and housing have risen far faster than the official CPI. These real-world costs, he explains, make the official inflation rate look absurdly low, and the true devaluation of the dollar may be closer to 7% annually, not the 2 to 3% figure quoted in reports. From an investment perspective, this central bank buying spree sets up a unique foundation for the gold market, one that Rule believes is not yet fully appreciated. The massive amount of gold being purchased is creating a solid base that, once retail investors enter the market, could propel prices significantly higher. When retail demand finally hits, it will be on top of a strong foundational support from central banks. Rule, with a hint of humor, refers to the potential for growth with the phrase, "You ain't seen nothing yet." The way he sees it, retail investors are only now starting to trickle in, as evidenced by unconventional players like Costco starting to sell gold. Yes, you read that right. Costco, one of America's largest retailers, recently introduced gold to its shelves, and it's been flying off at such a pace that the company is now expanding into platinum and palladium bullion. Costco's surprising entry into the precious metals market illustrates the beginning of what Rule calls retail participation, an indicator of rising public interest in precious metals as a hedge against inflation and currency devaluation. But this uptick in demand from everyday buyers has only just started. In examining why investors should view gold as an essential hedge, Rule draws a stark contrast between gold and its primary competitor, the 10-year US Treasury. The Treasury's yield, he notes, sits at around 4%, which may appear attractive on paper. But, he argues, if you consider the dollar's purchasing power is declining at a rate closer to 7% or higher, this return is deeply negative. Holding a 10-year US Treasury at 4% means losing roughly 35% of one's purchasing power over a decade. In other words, the so-called safe investment actually guarantees a substantial erosion of wealth over time. Rule takes this a step further by explaining that, for him, gold isn't merely a speculative asset that might climb to $2,500 or $2,700 per ounce. Instead, he considers gold a fear asset, a hedge he holds because he's genuinely concerned it could skyrocket to $9,000 or even $10,000 per ounce as a reflection of deteriorating economic conditions and a sharp drop in the US dollar's value. Gold isn't something he hopes will increase modestly. It's an asset he fears could surge dramatically if fiat currencies continue their current path of devaluation. As gold prices continue their steady climb, Rule predicts that this will serve as a leading indicator for the silver market. Silver traditionally follows gold in bull markets, and when it moves, it often does so with greater volatility and magnitude. Whether this shift happens immediately or in the coming years, Rule remains confident that a significant silver bull market is on the horizon. And when silver does break out, it won't be a subtle move. He recounts past bull markets, like the 1970s and early 2000s, when silver saw explosive gains, climbing from a few dollars to over $50.
I think I said on your show 7 or 8 months ago. I don't own gold because I think it might go through 2,500 or 2,700.
Yeah.
I don't own gold as a speculative asset class. I own junior gold shares as a speculative asset class, but I own gold because I'm afraid it's going to go to 9,000 or 10,000.
Yeah.
You don't have to go all the way back to the 1970s, where, of course, gold was coming off price suppression. It had been controlled prior to 1970. In the 1970s, gold ran from $35 to what, 850, something like that?
Yeah.
A better analog for today, because there's no price control today, a better analog would be the period 2000 to 2010, where the gold price went from $250 an ounce to $1,800, $1,700 an ounce. That's not a bad move, a 7-fold move in 10 years. So when people tell me that I am afraid that gold is going to go from 2,500 to 9,000, when I tell them I'm afraid it's going to have a 3-fold move, when I look back in history, that estimate's fairly calm. I'm not saying it is going to go to 9,000. I'm saying that I own it because I'm afraid it's going to go to 9,000. Now we've begun to establish real price momentum in gold. And price momentum in gold has traditionally been the leading indicator of a change in sentiment around silver. Whether it occurs now or it occurs a year from now, actually at 71 years of age doesn't matter very much to me, because silver bull markets are so profound that you can be a year early or 2 years early. And the amount of money that you make if you experience a silver bull market is so astonishing that the fact that you were a year or 2 years early doesn't matter. People say to me, Rick, how will I know that I'm in a silver bull market? And I ask them to look at charts of prior silver bull markets.
Okay.
You don't need to look for subtle symbols.
Like hockey stick.
Seminole bull market, the 1970s, the stuff went from $1.50 to $50. So
That's right.
Let's get that one out of the way. Let's go to one in the early 1990s that people don't remember at all, 1990 to 1996. The stuff went, if my memory serves me correctly, from $4 to $25, a 5-fold move in the silver price.
Okay.
That's for a bull market that people don't remember.
Yeah.
In the 2000 market, if I recall, silver had settled back down into middle single digits. I forget what the number was. Let's call it 5 just for fun. It's probably 10, I don't know. But it went from there to 50. The idea that people are concerning themselves about whether silver is 31 or 32 is laughable. It is absolutely, completely laughable. If I'm right about the primary direction of the the gold price, at some point in time, silver is going to break out. Silver hasn't moved, and people say, why, when gold has moved? Because until the last 4 weeks, central banks haven't bought any silver. The people who've bought gold have not bought silver. That's why gold has moved and silver hasn't moved. This is really simple stuff. Truly simple stuff. The Russian central bank has suggested that they are or will be buying silver. Apparently, the Indian central bank is reputed to have said the same thing very, very recently. This is a highly speculative activity if they choose to engage in it, and it might be that they aren't. It might be that those reports are fallacious. I would simply note to you that the reason that gold has outpaced silver is, first of all, because it always does in a bull market, but second of all, because the primary buyer of gold has been the central banks, and they aren't normally a buyer of silver. If, past this prologue, at some point in time in this gold bull market, leadership will pass to silver, and it will not be subtle based on past markets.
Rule continues by addressing a common question. Why hasn't silver seen the same upward momentum as gold in this current bull market? The answer is rooted in the central bank's purchasing behavior. Central banks are primarily interested in gold as a reserve asset. They have little to no history of accumulating silver. As a result, gold has surged while silver has lagged. Yet he predicts this pattern will eventually shift. If historical trends hold, the leadership will pass from gold to silver, igniting a powerful silver bull market that could dwarf current price levels. One potential catalyst for this shift is the emerging interest from central banks in silver. The Russian and Indian central banks, according to reports, have shown interest in silver purchases. This interest from government-level institutions is unusual and speculative, but could signify a paradigm shift if it materializes. Should central banks begin buying silver in earnest, it would add a level of demand previously unseen, pushing silver prices higher alongside gold. For now, though, the primary buyer in this gold bull market remains central banks, and that's the main reason for the divergence between gold and silver prices. In Rule's view, the US 10-year Treasury isn't just competing with gold for investors' attention, it's losing badly. The Treasury's 4% yield is effectively a guaranteed loss when inflation is factored in. Unlike gold, which has historically preserved purchasing power over centuries, The Treasury and similar fiat-based assets erode wealth over time. In this sense, Rule argues, holding gold isn't merely a bet on its price increasing. It's a form of self-defense against currency debasement. Rule's comparison reveals how gold serves as a safeguard against monetary policies that prioritize short-term economic stimulation at the cost of long-term currency stability. For those still skeptical about gold's potential, Rule explains that the current market dynamic reflects a broader, structural shift in how investors view traditional assets. The days of risk-free government bonds are numbered, and more people are waking up to this reality. The growing demand for physical assets, seen through Costco's entry into gold sales, signals that investors are starting to look outside the traditional financial system for security. Rule stresses that once retail buyers enter the gold market en masse, we could see a dramatic increase in prices. Unlike in previous bull markets, however, today's surge is being led by central banks rather than individual investors, a sign that those with the most insight into global economic health are preparing for stormy times ahead. Rule is equally bullish on silver, emphasizing that its price has only begun to scratch the surface of its potential. In prior silver bull markets, the metal often lags behind gold, but catches up rapidly once momentum builds. For example, during the 1970s bull market, silver rocketed from around $1.50 per ounce to $50, a staggering increase. In the early 1990s, it saw a similar five-fold rise, climbing from $4 to $25. And in 2011, silver hit $50 again, demonstrating its ability to rise exponentially during times of economic uncertainty. Given today's economic landscape, Rule believes that a silver breakout is imminent. He encourages investors not to worry about incremental price changes in the low $30 range. When silver finally breaks out, he predicts it will gush past its historical highs of $50, potentially reaching levels that could surprise even the most optimistic investors. As a bull market in silver takes hold, Rule expects the price to rise vertically, surpassing prior peaks and awakening the world to silver's value as both a monetary and industrial asset. Central banks may not yet be major buyers of silver, but the demand drivers are already there. With rising interest in green energy and technology, silver's role as an industrial metal provides a unique investment opportunity. Solar panels, electric vehicles, and various electronics require substantial amounts of silver. As the world moves toward renewable energy, silver's industrial demand will only increase, adding upward pressure on prices even without the influence of central bank buying. Once retail investors recognize the value proposition in silver, both as an inflation hedge and an essential industrial resource, Rule believes we'll see an unprecedented surge. Reflecting on the current price momentum, Rule emphasizes that gold's steady ascent has traditionally been a signal for silver to follow. This sequence has repeated across past bull markets, and Rule sees no reason why this time would be different. The significant difference now, however, is the foundation built by central bank buying. In previous bull markets, retail investors led the charge, but today the underlying demand from central banks has set a solid floor for prices. Once retail investors join the fray, prices could skyrocket, driven by the combined forces of institutional and individual buying. In closing, Rule issues a warning to those who are still sitting on the sidelines. The time to act is now. Waiting for a perfect entry point may result in missed opportunities, as prices are likely to continue their upward trend. The current market dynamics, central banks accumulating gold, Costco selling out of bullion, and reports of central banks considering silver purchases, suggest that we're on the cusp of a historic bull market in precious metals. For those who may be hesitant to invest in gold or silver, Rule offers a simple piece of advice. Look at the alternatives. The US 10-year Treasury, once considered the gold standard of safe investments, is now a guaranteed loss in real terms when adjusted for inflation. Meanwhile, gold and silver provide not only a hedge against currency devaluation, but also the potential for significant gains as global demand continues to rise. Ultimately, Rule's message is clear. The gold and silver markets are undergoing a transformation driven by factors that extend far beyond traditional retail demand. This is a bull market unlike any we've seen before, led by central banks and soon to be joined by retail investors. For those paying attention, this is a golden, pun intended, opportunity to secure assets with a proven track record of preserving wealth. As Rule succinctly puts it, when retail finally joins the central banks, you ain't seen nothing yet. The stage is set for an unprecedented run in precious metals, and those who recognize the signs will be well positioned to reap the rewards.